Inflation has dominated financial markets for several years, but the most important indicators aren't found in CPI releases. They live in two market-based measures: inflation break-evens and real yields. These indicators, derived from tips and nominal treasuries, give you a direct, real-time readout of the market's expectations for inflation and economic conditions. But they require careful interpretation because both metrics reflect far more than just price pressure. Let's start with break-evens. A break-even rate is simply the nominal yield of a treasury minus the yield of tips of the same maturity. At face value, it represents the market's expectations of future inflation, but that definition is overly simplistic. Break-evens embed several components: a true inflation expectation, an inflation risk premium, and a liquidity premium. During stress, liquidity can evaporate in the tips market, causing break-evens to fall sharply, even when the real inflation outlook hasn't changed. This is why break-evens collapsed in early 2020, not because the market believed inflation would disappear, but because liquidity dried up and investors fled into the easiest to trade securities. Real yields tell a different but equally important story. Real yields represent the inflation-adjusted return investors demand. When real yields rise, discount rates across financial markets increase, tightening financial conditions. This affects everything from equity valuations to mortgage rates to corporate investment decisions. A shift in the 10-year real yield from 0% to 2% has historically caused more market repricing than an equivalent move in nominal rates. There is another nuance to consider. Break-evens and real yields often move in opposite directions during stress. In a risk-off environment, investors buy tips for safety, pushing real yields down, but break-evens may simultaneously fall because inflation risk premia collapse. This can create misleading narratives if you're only looking at one metric. To truly understand the macro landscape, you need to monitor the relationship between the two. Rising break-evens with rising real yields suggests strong growth and persistent inflation pressures. Rising break-evens with falling real yields signal stagflation concerns. Falling break-evens with rising real yields suggest that tightening policy is gaining credibility. Break-evens and real yields are the bond market's heartbeat. They reveal not just what investors think inflation will be, but how confident they are in policy, how tight financial conditions are becoming, and where risk sentiment is heading. For traders, corporates, and investors, these are essential tools for navigating macro volatility.